Understanding joint ventures, JVs definitions, advantages, disadvantages, and examples. Joint ventures, JVs, have become a popular strategy for businesses seeking to expand their reach, utilize combined resources, and share risks. This article delves into the intricacies of joint ventures, their formation, benefits, challenges, and real-world examples. What is a joint venture? A joint venture is a business agreement between two or more parties to collaborate and pool their resources for a specific project or business activity. Unlike a merger or full partnership, a joint venture operates as a separate entity, maintaining its own identity distinct from the participating companies. Key characteristics of joint ventures. Separate entity. JVs form a distinct entity from the parties involved, responsible for its own profits, losses, and liabilities. Shared goals. Participants agree to pursue a common objective which can range from product development to market expansion. Flexibility in structure. JVs can be structured using various legal frameworks, including partnerships, LLCs, or corporations. For primary reasons companies form joint ventures. 1. Leverage resources. Different companies bring unique strengths into the JV, maximizing the potential of shared resources. For instance, one company may excel in manufacturing while another dominates in distribution. 2. Reduce costs. By pooling resources, companies can reduce costs through economies of scale in production, marketing, and distribution. 3. Combine expertise. Different backgrounds and specialties enrich the project by leveraging diverse knowledge and capabilities, enhancing innovation and efficiency. 4. Enter foreign markets. Forming a JV with a local firm is a strategic way to navigate market entry barriers in foreign countries, leveraging the local partner's established presence. Setting up a joint venture. Creating a joint venture requires careful planning and drafting of a comprehensive agreement outlining each party's rights and obligations. Key components of a JV agreement include objectives and contributions, clearly defined goals and the resources, financial or otherwise, each participant will contribute. Operational framework, daily management and decision-making processes must be established. Profit and loss sharing. Agreements on how profits and losses will be divided are essential to avoid future disputes. Advantages of joint ventures. Shared risk, offering a way to undertake a project without individually bearing all financial risks. Access to new markets and resources, facilitates entry into new geographical areas by cooperating with local experts. Expanded capabilities, combines skill sets from different organizations, enriching the overall output. Disadvantages of joint ventures. Loss of control. Decision-making is shared, which may lead to conflicts if the parties have divergent goals. Cultural clashes. Different corporate cultures can hinder communication and collaboration. Management complexity. Coordination between multiple entities can initiate confusion and complicate processes. Tax implications of joint ventures. The tax obligations of a joint venture are determined by its legal structure. As many JVs are registered as corporations or LLCs, they pay taxes similar to those entities. However, certain arrangements may allow for profits and losses to pass through to the individual partner's personal tax returns. It is crucial for parties involved to define tax responsibilities in the JV agreement. Joint ventures versus partnerships and consortiums. While joint ventures and partnerships both involve collaboration, they are not synonymous. A partnership is a single entity formed by two or more parties, whereas a joint venture creates a new entity that combines resources from the parties without replacing their original structures. A consortium, while similar, is generally an informal collaboration without creating a distinct entity. Real-world example of a joint venture. One notable example of a joint venture is the collaboration between Sony and Honda, announced in 2022, aimed at developing an electric vehicle by 2026. Sony leverages its expertise in electronics and entertainment, while Honda brings its automotive skills to the table. The joint venture, named Afeela, plans to commence pre-orders in 2025. Why a firm would enter into a joint venture? Companies may choose to enter into a JV for various reasons, such as expanding their market share, developing new products or services, reducing costs through shared resources and expertise. The structure provided by a JV allows for shared liability, making it an attractive option for companies looking to mitigate risk in uncertain markets. Common exit strategies in joint ventures. An effective exit strategy is essential for any JV. Typical exit strategies include selling the business. One party purchases the other's shares. Spinning off operations. The JV may be transitioned into its independent operation. Employee ownership. Employees are given partial ownership, fostering commitment. This clarity prevents potential legal complications and miscommunication when the project concludes. Conclusion. Joint ventures offer a strategic pathway for companies to achieve shared goals while blending different sets of expertise and resources. While JVs come with inherent risks and complexities, their advantages, such as cost sharing, risk distribution, and mutual support, can yield significant rewards if executed thoughtfully. Aspiring business partners must ensure alignment in objectives and culture to optimally harness the benefits of joint ventures.